All right, Brett. So yeah, if you don't mind kind of introducing yourself and talk about, your background in cryptocurrencies as well as your background in the derivative space and whether you trade options or futures and so on.
Yeah, sure. So I started out in like kind of the equity prop shop broker dealer actually within our CEO's family office about 4 years ago, and got into crypto pretty much right at the tippy top in like November, December 2017. We were doing, there's the cross exchange ARB was kind of like the easiest way for us to get into the space at the time, and kind of building out what eventually, became the foundation of Galaxy's trading business there. Those spreads obviously tightened up pretty quickly. So at that point, we pivoted to kind of our OTC business and kind of started building out the franchise that you guys know today. And since then, it's pretty much been, we've been trading derivatives pretty much from the start. Options, I'd say more so started like 2019. But we've been active in the futures markets, spot OTC, as well as a variety of different kind of prop strategies that we run.
Fantastic. And Galaxy Digital, is that, where is this company located? Is it an American company in Hong Kong?
Yeah, so we're based in New York, publicly traded in Canada, with offices in New York, New Jersey, London, Tokyo, Hong Kong, and Chicago more recently.
Oh, fantastic.
Well, yeah.
Thanks, Brett. It's great to meet you. Julien, if you would love to kind of give us a little bit about your background, talk a little bit about Orca, what kind of markets you guys focus on, and whether you've been trading, how long have you been trading cryptos? How long have you been trading derivatives markets?
Sure. Yeah. So basically for us, crypto journey started 2017. We started really small from scratch, basically, and tried to do some options market making on the platform Deribit at the point when it just basically started. And we had little experience with that. I was at that time still an electricity futures trader, so trading intraday electricity futures in Germany, Europe. So, but since then, basically, we have grown our shop to a fully fledged options trading shop. I would say we are mostly trading options. We are kind of a prop shop. We do mostly options market making on screen through algorithms. We do futures arbitrage. We do outright delta strategies. We do vol trading. We do like all kind of different strategies right now. And we've since 3 years grown considerably. And basically now we are just a prop shop in the crypto world, basically.
Awesome. And are you the founder of Orca?
Yeah, so basically I started Orca with Victor in 2017, and later Michael, our third co-founder, joined us basically. And we started pretty small by basically just quoting two-sided markets on Deribit at the time when there were no other big market makers, let's put it this way. And basically, since then, we've grown with the exchange, but also since then, we've grown our portfolio of strategies. So in the beginning, it was really just data neutral market making, which then evolved into vol trading, which later evolved into what I would say called structural arbitrage, which then evolved into directional play. And now we're also active in the altcoin space and basically everywhere. Like we do whatever we can get our hands to and where we see an edge. The portfolio has kind of grown, went really wide.
Oh, fantastic.
Yeah.
And are you guys are located out of Germany, is that correct?
Yeah, so we're currently based in Germany. We are actually planning to relocate our head office, but due to expecting some family addition, we might postpone that a bit into the future. But yeah, currently we're based in Germany, Düsseldorf.
Fantastic. Well, congrats on the family addition. We'll jump over to Joshua from Orthogonal Trading. Hi, Joshua. Can you hear us? Can you hear me?
Yep. Yeah. The short version about our background is we started kind of Feb 2020, me and 2 other partners. So I was already in crypto at the time, full-time trading options and derivatives and a bunch of stuff. Before that was in traditional markets. Both my partners came from traditional market roles straight into crypto in 2020, though they'd been trading crypto PA for a bit. We have effectively what I would call our own GP balance sheet, and then we have a fund structure as well where we take external capital. We do for a lot of options, so over half our balance sheet now is options, combination of relative value, delta neutral stuff, market making, and more structural volatility and like options to build delta positions as well. Then we do a bunch of arbitrage stuff, so CFI and DeFi, from farming to perp versus spot, all that jazz. And then the last thing we run for external capital is what we call systematic delta trading, which is like trend following models, mean reversion models, all that kind of stuff. And at our GP, we do a bit of VC stuff as well in projects where we think we can be helpful.
That's fantastic. And where does the name Orthogonal come from?
That comes from a bunch of text messages on WhatsApp and no one really knowing what to call it. So I can't remember who came up with that name now. So I'll claim it and say that I did. But there's no great story behind it. I just think it's a kind of orthogonal is it's like differentiated, adjacent to, so different strategies to most.
Love it. So Brett, we'll jump back to you. So what's your day-to-day activity look like over at Galaxy? What do you what time in the morning do you come into work, and what kind of things do you kind of check in the morning when you first roll in, and what's your typical day look like?
Yeah, well, I mean, as you guys know, it's hard to plan stuff in crypto, but on a normal day, if normal exists, probably getting up like 7 or so, checking screens, catching up on chats. I mean, for us, like we're very deep into the OTC space, both on the spot and derivative side. So it's kind of like, especially here in I'm in Hong Kong right now, and so it's catching up on chats overnight for at least the first half hour, usually just kind of like seeing what went through, what's still outstanding, what kind of risk we have on, that sort of stuff. And just kind of getting a pulse for the market. And throughout the day, I'd say it's a mix of, if it's busy, kind of just dealing with client flows on the spot and derivative side, and that tends to take up a good bit. But on days where it's more, it's more calm, I try and read, catch up on research, news, things like that, and help build out some more like kind of analytical tools for our risk models, working with our tech team to kind of improve our internal risk systems, things like that. So it's a bit of everything. I guess also doing, a bit of like a biz dev type work here, client meetings, things like that. So I think everyone at Galaxy typically wears a lot of hats, and that's definitely true in Asia. I mean, we're pretty lean out here. We only have like 7 people in Asia right now. So a little bit of everything.
Very cool. And then what does a day look like when things are just kind of crazy and you're like barely made it through the day? Is it mostly just clients calling you guys up for quotes and you're just sort of on the phone all day and can't really get anything else squeezed in, or is it something different? Maybe a system?
Yeah. I mean, that's definitely a large part of it, right? I mean, it's Telegram, WhatsApp, Skype, Slack messages, Bloomberg chats, right? Just providing liquidity, and in addition, like we run a number of proprietary strategies on our end as well. So kind of keeping the clients happy, responding quickly, managing the book's risk. It's days like that, I mean, we're approaching almost a year now to what was probably the craziest day, at least of my professional career. Days like that where, you're just adrenaline's pumping the entire day. You're not leaving the desk, that sort of thing. You realize you're there 14 hours later and you haven't left, right? So, so it's highly dependent on what's going on in the market. Crypto never a dull moment, really.
Yeah, market that never sleeps either. So yeah, I totally get that. And I think for those who are not familiar to what Brett's talking about, I'm pretty sure he's talking about the March Madness we had last year at the peak of the sort of the fear of the coronavirus, and sort of all the markets and all the asset classes had a major meltdown, including Bitcoin and the rest of the cryptos. Julien, I'll jump over to you. What does your day-to-day look like, and what does a normal day look like versus what is like a crazy day where you're barely making through to the other side?
I would say the craziest days are the days with all-nighters. We had a couple of these last year. Luckily this year not, but yeah, basically for me, like it changed a bit. Like in 2007 when we started out, it was a lot of coding. In the beginning, the 2017 bull market, we kind of missed that market sort of because we were always data neutral, just market making, really hedged, had not a big view on the market. But that all has shifted. Like that time we were building our systems. Now it's a bit more different. So right now I would say like a bit, like an integral part of our work is definitely evolving our systems, our trading systems, and our whole infrastructure basically. So we are like a couple of, like, let's say 1 or 2 hours a day is always spent in just optimizing and refining that. And the other times, most of the time, it's about probably observing, looking at the markets, hanging around in Telegram chats, and having a very close eye on volatility. So we're basically probably we're constantly monitoring implied vols in the markets, in the options markets, and obviously quoting markets around these vols. So kind of we always have to be very close to them, especially if there are big moves or so. But then it's really a lot of stuff is really like just observing and trying to see patterns. And then yeah, usually I would say on a day like maybe there's between 1 or 3 hours which I can dedicate in focused coding. Because like I personally can't spend more time in that because it's just so mentally straining. So it's always a bit because like especially in the volatile times, like it can really rob the productivity, because when Bitcoin is going crazy and there are a lot of big trading opportunities coming up, you have to wait and sit in front of the screen and just look at all our systems, all of our indicators, and basically just reiterating this the whole time and trying to find setups which we can refine, or actually refining our positions, especially when you manage a very large vol book. Basically, you have in every tenor and every strike there are like positions, and you have to monitor that at all times, see if there is some specific flow which could be of interest, and so that's always like it's consuming a lot of time, especially when the market is volatile. So right now, actually, I'm kind of praying for some calm sideways movement, to be honest. Would love to take some vacation, but at the moment, it's just really difficult. And yeah, it's just, yeah, there's so much opportunity in this market at the moment. It is mind-blowing. Yeah, so drifting off a little bit here.
Well, that's great. That's great. It gets me amped up on the crypto markets. So during the March Madness, I remember I was looking at the Derivatives screens and excuse me, I was looking at Derivatives screens, and there was sort of market makers were there. I mean, they were on the bids and the offers during sort of that whole meltdown for the most part. Were you guys market making on that on sort of that big crash day last March of 2020? And was that something that was stressful, or was that something like, yes, this is finally happening?
Yeah, so it's an interesting question. So basically, like I would say there's two types of market makers. There's like the ones that run fully automated. Like we are not these ones. I think they are also like the biggest on Deribit, and they're actually pretty unknown. These guys are most of the time always around quoting markets. Also, usually then of course during volatile times and very wide markets. For us, we noticed during these high volatility days, the biggest edge for us is actually not in market making, because it sounds a bit weird, but you get picked off and stuff. So usually we go very wide with our quotes on these days. Just don't care. We put the votes where we think they are kind of fair, and we manage the book from there. And usually also our biggest P&L swings have happened during these times of high volatility. But we focus most of the times on future spreads trading them, because that's kind of is what really goes nuts. Last year, one of our best days was actually the March crash because of future spreads dislocations and stuff like that. So usually we go a bit like wider with our quotes. We are and just trying to manage to basically manage the options book in a kind of very neutral risk-off fashion kind of, and try to focus on, in particular, managing the delta and the future spreads, which I see a lot of edge in. And obviously OTC, there's a lot of stuff going on, and then you really have to pick your flow, I would say. Like, we're definitely not the ones that provide perfect liquidity during those times. I mean, yeah, it really depends. Like, usually as market makers also, like, your portfolio is usually geared towards, I would say, geared towards extreme movements, because you always want to be in the, you always want to have the ability to make markets if there is actually something happening like this, and especially also the few days afterwards. If you're, for example, like big gamma short into an event like the March, you will struggle to show any markets to anyone, because you will just like try to get your portfolio together. But if you kind of always sort of smoothly gamma long or flat, at least you and have some tail risks in, at least then you kind of have still the ability to show markets. But I mean, we've also seen, like, especially during these heavy volatile markets, we also don't see too much OTC requests. Like, on screen, there's a lot of stuff going on, but I think most of the people during this specific time of the crash don't want to trade now big ticket sizes. Usually they want to pick spots where it's a bit calmer. So yeah.
That's great. That's really interesting. Thanks, Julien. Joshua, we'll jump over to you. So what's your typical day-to-day look like? What's a kind of an average day? What kind of activities do you do on those regular days? And what does a crazy day look like? And how was March for you, March 2020?
Yeah, so I mean, the average day, I guess, is you get up, check the books. We have someone on our books 24/7 pretty much. So, you know, we'll have a chat in the morning, you know, while everyone's kind of awake. What happened overnight? What are we all thinking? You know, what do we think looks cheap, expensive, good, bad, indifferent? What's our kind of plan? Then, you know, as to how the day evolves, I would say it's like market dependent. If it's busy, or if the market's moving a lot, then we'll be focused on, you know, trading. As Julien said, it's a lot of periods of inactivity, watching things, trying to figure out what's happening, figure out good positions, punctuated by like periods of madness when you're executing, you know, stuff, or adapting to things that are happening. You know, when we're not trading, generally either working on systems, working on trading strategies, you know, watching the markets, trying to figure out what to do next, what to do if X and Y happen, managing some of our non-option strategies, like, you know, DeFi related stuff, and all that kind of jazz. So generally it's predominantly trading focused. The function of time we spend that is not directly trading and is more in the strategy development, you know, analysis side is a function of how busy or how crazy the market is, basically. So yeah, I mean, March was pretty crazy, and I remember not getting very much sleep for quite some time. So what would my major? I mean, so we had a good March. We were long Vega and long Gamma. We were actually short downside before the big crash, so we had the risky on the wrong way, but we flipped that position pretty quickly once the market turned, and spent most of our time paying downside Gamma at what seemed to be optically ridiculous falls. But that worked fine because the market was even more ridiculous, but in a nutshell. So I think the point about the future spreads is very true. Like, there was a lot of opportunity there. Remember some of the ETH, like 1 month futures, perp futures was like absurd. So yeah, we had a kind of situation where we generally sit long wings, long convexity, long options that if the world blows up, people want to buy from us. So, but the market did move so far actually that we derived into some kind of short options. But you know, that was fine. Once when the market moves so much so quickly, you pass through your strikes like quite quickly from one, you know, like different strikes. So your Greek profile can change quite quickly as well. So a lot of it is like managing that. And you know, if you move from like say say you move from a pocket of a long gamma to a pocket of short gamma, you know, like sorting that out, and then like maybe move back to a pocket of long gamma as well. So like managing the change in your Greeks as you move through vol and spot levels. So it was a lot of that type of stuff, but we generally had a good day, and most of our kind of systematic stuff was short, so that helped us as well.
Love it. Thank you so much.
Yeah.
Brett, we'll jump back to you. So basically, you know, over the past 12 months, we've seen a lot of, you know, record volume in the derivative space, both in the future space and the option space. We had the launch of Bit.com, which is the host of our great panel right now, basically launching options, being one of the new main venues, launching different types of options. We have some Bitcoin Cash options that just recently launched. And then we have growth at sort of, you know, partners like Paradigm, who are doing a lot of the block trading. Where do you see the sort of the growth in the crypto derivative space coming from? And is it mostly towards futures, or are you seeing a lot of this growth hit you guys on the option side as well?
Yeah, I mean, I think you said it well. Like over the last year, it's really been exponential. I think both in futures and options. I mean, primarily, prior to, let's call it April or May of 2020, I knew it was largely speculative flows, right? Like there wasn't a lot of the flows were crypto to crypto, like crypto specific funds, right? You didn't have these large institutions coming in and allocating capital and looking to manage risk and, you know, deploy a variety of different strategies, you know, getting yield off their holdings, so on and so forth. But yeah, so I think it's a function of you know, more, you know, I mean, quite frankly, just more money and more participants coming into the space. You know, I mean, what was it like? You had, I mean, options and futures, I think they both like probably 10x what they were a year ago, something like that. So, you know, like more venues, like Bit.com, as well as, you know, I mean, it was no secret, like BitMEX was the king, right, for the longest time. And post-March, we really saw the proliferation of you know, USD and USDT margin futures, you know, which solved for at least one piece of the issue there with you know, a runway risk for anyone that was long, right? So, you know, I think really just the institutionalization of the space built like that broader capital base, right? Lifted markets and got people a lot more interested. For us, like we'd seen, I'd say like our customer, or rather our client flows, really started to pick up in the derivative space like May or June, when things started really getting exciting. With, you know, you had like the Paul Tudor Jones announcement, and things started like, you know, the kind of that baseline career risk was sort of removed from crypto, right? And at that point, things just started to kind of take off. Saw a few systematic yield kind of strategies emerging from like, I mean, like quite chunky size from a few funds, right? You saw like CME options open interest expanding there, and then that translating into Derivatives, and then eventually to Bit.com, right? So yeah, I mean, I think the biggest driver has just been more capital, right? And more sophisticated players coming to the space, right? We had, you know, it was we had a few systematic clients, mostly yield seeking, but then as things started to really start to turn up, call it like after it became clear that like that meltdown in September was kind of basing out a bit. Saw a few kind of, let's say, vol funds or just kind of, you know, players from the traditional space, you know, actively trading positions around, as well as you know, crypto native funds who had, you know, typically just stuck to the spot and futures area, coming in and you know, picking up some upside while vol was absurdly cheap for a handful of months there, and more recently seeing some yeah, it's a bit harder now, but you know, seeing folks coming in, and, you know, I think you have a lot of funds who are now, you know, mega long DeFi, right, betting on that secular trend, who, you know, and I think that's done numbers for growth in the ETH options market, right, as that sort of natural hedge. So yeah, it's been a wild year, but yeah.
And Brett, just kind of as a follow-up question to sort of that, do you ever see any sort of dislocations between sort of the on-screen markets versus the OTC markets that some of your customers are requesting? So, I had read in the Genesis Trading sort of quarterly report that they just released that there's a lot of demand OTC for option overrights. So customers basically want to sell some covered calls on their assets, and you could see a dislocation in the implied vol for calls on the OTC quotes versus the on-screen quotes. Is that something that you guys have noticed as well in the Galaxy Digital sort of client flow?
Yeah, definitely. I mean, I think it's gotten, the two have converged a lot in the past few months as things have gotten a lot more liquid. But in the early days, right, like, I mean, derivatives screens were really wide compared to where they're at now. But I mean, the main difference on the OTC side is really just the flexibility, right? And size, right? Like, I mean, the bulk of our stuff is probably done OTC, kind of chunkier corporate flow, if you will. I mean, it's a bit, I mean, the transparent nature of crypto makes it a bit hard to go out there and ask someone for, a few hundred or 500, 1,000 Bitcoin, right? I mean, sites like your own, right, will print it and tell you exactly who is trading what, right? So I'd say the size and flexibility is the main difference in the OTC space, but the vols have, the spreads have definitely compressed a bunch. And, it's really just a function of kind of where things are in the market, right? I think for a while, the flow tended to be one way, and that, like, everyone was a seller for a few months. And so, you can get some pretty interesting axes and scoop up some cheap stuff every now and again. But I mean, in this regime, near 100 vols, right? It's people haven't really been jumping out of their shoes to lay on it. Particularly where at all-time highs, we're seeing a bit of an uptick now, and people coming back and looking for some yield. But a lot of those strategies went quiet for a bit, and that was clearly reflected in the explosive growth in both spot and vols.
Love it. And for those new to sort of vol trading in the audience, just to kind of give you some context, right now Bitcoin is about 100 vol, and Ethereum is about 120. And at the peak of sort of the coronavirus panic, S&P 500 vol was about 85. So that's where sort of the VIX peaked out. So as far as crypto volatility goes, it's 15 points above the peak for Bitcoin. So just kind of give you some context around sort of the vol regime we're in right now. Julien, I'm gonna jump to you real quick. So you guys being a prop shop, I'm sure that you guys maybe sometimes do some OTC stuff, but where do you think most of the client flow is coming from when you're market making on sort of the CeFi markets? Is that more professional traders trading against the markets that you're making, or is it a lot of speculative flow and sort of retail traders? Where do you see the drivers of sort of that volume?
It's interesting. It's a good question. I mean, we are mostly active on Deribit, which has definitely a lot of institutional volume. We are not active in the OTC non-exchange cleared stuff. So we are not doing real OTC, but we are doing OTC exchange cleared. And these are definitely accounting for the probably largest volume, options trading volume on Deribit. And basically, we see a lot is that the biggest flow, I would say, is actually coming from institutions. I mean, it's then usually other options shop, like probably Galaxy, or I don't know, or QCP, or other big shops that basically take some OTC flow and then basically try to get rid of some of that on Deribit kind of, and we are sort of in the middle between that. So kind of, I would say most of the big ticket stuff feels like it's coming from institutional clients, and I would say most of that is kind of yield collecting. So most of that is actually is actually vol selling. So there's no doubt about it that we see massive put selling on Ethereum and Bitcoin. Have seen it in the past, but even right now, it's like, if you look at the open interest, people sell like vols like crazy. And I would say this is usually large funds doing some sort of yield searching strategies. So that's one part of the flow. And the other part of the flow, I would say, there are also other big tickets. These usually come from, I would say, rather individual large traders, probably known on Twitter. And these guys usually buy calls in big size. So usually, I would say that's kind of really the different flow. You've got the vol sellers on one hand, and then individual traders buying calls. What I see probably the least is people buying puts for any reason. Like, I mean, if you look at Bitcoin, I mean, trading it from the short side is, in that trend, usually it's not the biggest risk reward. So even for us, like most of the time we are flat or we are delta long, but being outright short seems like a bet no one wants to take. And so that's also like what we see on the vols. On screen, it's a bit different. On screen, like it's sometimes completely different flow. So there can be like, yeah, we can see all kind of stuff there. Like, I mean, sometimes people try to accumulate on screen some larger positions, but most of the time that's like rather uncorrelated. Sometimes you can see somebody's like putting in big orders and like just fixed price orders or so. So then you know, okay, that's probably one guy who desperately wants a position but doesn't want to go through a paradigm or so. But yeah, that's how I see the big differences of the flow.
Fantastic. Let me follow up on a couple quick questions. So we have, you know, a couple more venues coming online, bit.com and some other ones as well. Do you ever see any sort of deviations amongst the different the online C5 venues?
So I mean, like for example, on FTX, that's quite an interesting one, because FTX has all kind of different contracts. They also have the move contracts, and they are basically pure Vega contracts, and you see sometimes very big dislocations between the implied vols implied on the move contracts versus the ones which we see on Deribit. On the other options, I don't see too much difference because we're not too active on them most of the times, because like for us at least, it's most capital efficient to have the collateral in kind of fewer spaces than more spaces. So it's always difficult to go to like OKX or bit.com and then deploy some capital there too, if actually also kind of similar trading to what we see on Deribit. But yeah, there can be dislocations. Usually it can be inventory driven, can be kind of all kind of reasons why they're there.
Cool. And sorry to bug you one more time. I'm going to ask you one more follow-up question. So
Sure.
You mentioned a lot of put selling. You see a lot of put selling on the flow, on screens. Something that I've always been kind of paranoid about when it comes to sort of put selling vol is that there's a lot of negative convexity to sort of selling a put in the crypto coin denominated account versus, you know, in the stock market. If you sell a put and you have cash, you can have a cash secure put and you'll never blow up because you can always just take in the underlying at the strike price. But in crypto, as the underlying asymptotes towards zero, your count, you know, just selling one put could theoretically go to, you know, infinity negative crypto loss, meaning that if you sold a put at 1,000 on Ether and if Ether starts heading towards, you know, sub $1 and sub 10 cents and all the way towards a penny, your short one put is going to be worth a lot of Ethers, which could blow up your account. How do you view that risk as far as put selling goes? And do you think that is an actual risk? I know some of these exchanges have circuit breakers and stuff like that, but do you see potential flash crash risk like that?
I mean, I'm always afraid of these kind of risks because when I see that somebody is selling in very big size of however many puts, yeah, that definitely scares the shit out of me. But then we have to see like who are the sellers. Like for me, I know personally who are the largest put sellers basically in the crypto space, I would say, and because of that, well, I would say I'm not fearful that there would never be enough capital from these guys actually. And it also depends on like the kind of type of strategy that you can build. Like for example, on like there are a lot of payoff strategies which you can build by selling vol or selling some kind of vol, which generate a payoff which actually looks pretty interesting. Like for example, right now the December is trading in a big contango. So we've seen that the December futures are actually $10,000 higher than the spot price. So it's already pretty extreme. But at the same time, you could, like, for example, structure an options trade, like by kind of selling some calls, buying different calls against it, which yield you something between 0 or 66% upside for your collateral that you posted. So there are some like really interesting payoff possibilities possible by selling vol. I mean, it's because we are market makers, it's not what we do, because we always need that gamma, need to trade it, and need to be able to make markets. But I mean, I can imagine why there are some people who want to trade this, who want to sell vol for some reason. Also, I mean, sort of like, yeah, if you miss the bull run, maybe some people actually sell puts because they say like, if it drops to a certain level, then I'm just going to write down the money that I will invest, and that's like what I'm going to have. I mean, like, there's validity to these vol selling strategies. Also, like, probably the biggest vol selling strategy right now is liquidity providing on DeFi, because that's effectively, like, it can be compared to selling straddles or selling strangles. Basically, it's like there is an analogy between DeFi liquidity providing and selling vol. So like probably that's also where you see it in action.
Very cool. Very cool. Joshua, we'll jump over to you. So basically, maybe if you want to touch on kind of where do you think sort of your counterparty flow is mostly coming from? Have you seen a lot of growth sort of in the volumes, and is that something that you think is mostly from institutions or sort of retail? And then from there, we'll jump into a couple of questions, and we'll start with you as well.
Yeah, sure. So I would say that for the majority of our lives as a firm, still we've been taker only. We've only really kicked into the market making maybe over the last, I want to say, 5-ish, 6 months roughly, for a couple reasons. But within that space of time, I think I would just support what the other guys have said. Really, predominantly, you know, vol selling, especially topside vol selling by institutions. The kind of firms that I think are broadly known as yield enhancement firms, and then, you know, the kind of hedge fund manager, high net worth prop trader flow, which is generally, you know, more directional in nature, and, you know, generally going for a different type of payoff, you know, if they're trying to collect multiples as opposed to just a yield. So it's a bit different in that sense. So yeah, I mean, we do all our market making that we do is blocks on Paradigm. We don't do any sort of auto quoting on screen, or that any of that kind of stuff. We do effectively the large tickets from a kind of prop buy side market making perspective, whereby, you know, we'll be generally very good on stuff that we like, that suits our book, suits our views, but, you know, we're not we won't be the best if it doesn't, basically, in a nutshell.
Yeah, that makes sense. Have you seen sort of a change in sort of the people asking for quotes on Paradigm? Is it still sort of professional traders, or do you see finally some more smaller traders requesting quotes?
I mean, we see smaller traders. It's kind of hard to tell, though. I mean, often it's just a random screen name. You know, we don't really know anything about them per se. So are they small or big? I mean, you can tell by the ticket size that they try to put through, but you never quite know if there's more behind or if that's it as well. So maybe they put through, I don't know, 25x or something, and you say, oh, cool, it's not much. And then 10 clips later, you're like, oh, okay, so there's some stuff there. Or, you know, someone else might be like, yeah, cool, I want to do 1,000 of this. You're like, fine. They're obviously large. So it's a bit, you know, you never quite know until after the fact.
Very cool. Very cool. So I'll kind of start this question with you. Do you see sort of in the traditional markets and in stocks and stuff like that, there's, you know, known vol events. So, you know, FOMC meetings are great vol events for the bond market. Earnings are huge vol events for the stock market. And do you think that vol events are mostly macro driven in the crypto space, or are there sort of crypto specific vol events like an upcoming hard fork, or you know, I remember when Vitalik was rumored to have died in a car crash on in Ethereum 3 or 4 years back. That crashed the Ethereum market, just that rumor alone on Twitter. Do you see any sort of vol events that are crypto specific?
Yes, I think. Well, you could separate it into two categories. You have the bowl events that we know about in advance. So like hard fork, I would say there aren't many of them. They're pretty rare. Hard fork is one. Another one might be layer 2 stuff. It could be ETH 2.0 or anything like that could present a meaningful fundamental shock. Or like a large piece of news, generally like a Mt. Gox meeting or something. I would put into that category. And then you get the random ones generally because the apes are too levered and it all gets stopped out in some sort of carnage. So that would be a second type of ball move there. I think there's some ability to predict that stuff, but you're not going to be like, oh, I want to do the 1 day, 2 day option spread to take advantage of the upcoming liquidation run. That's a bit more just like random and how you would set your portfolio up, I think, from a general bias point of view, if you want to be long gamma, short gamma, structurally, etc. So yeah, I think the short answer is yes. Not that many though. And there's some opportunities around them, I would say, depending on how complex you need to get or want to get. I don't think you generally need to get that complex in crypto. You can, have some idea of what you think it will do, and is that priced into the market or not? And then it's like fairly simple. We have done some work around options edge on TradFi events, so like on a Fed meeting and stuff. Generally think that's like not much fat there, but every now and again, you get surprised. There could be something, but it's generally not something that the market prices a premium on at the very least. So it's up to you to decide if you think there should be one.
Cool. Love it. Just kind of a follow-up question there. So if you take sort of the academic worldview of the markets, you have this theory that markets are perfectly efficient. I'm sure that none of us believe that, since we're all traders in the market. Assuming that worldview, is 100% efficient, and you'd call, say, the traditional markets, whatever it is, maybe 85 or 90% efficient, where would you scale the efficiency of the crypto markets?
That's a good question. Putting a number on it. If you call TradFi 80 to 90, a while ago, crypto would have been below 50, but there's enough smart people looking at it now that it's getting a lot better. I'd probably put crypto somewhere in the 65 to 80 range, depending. I think often when it's mispriced, it tends to be quite mispriced. And it has its own kind of quirks. So whether you would call that a misprice or not, maybe is in the eye of the beholder. One big difference I think that you would find is say you put on a RV trade in FX or in rates, right? Generally, there's a lot of people looking at that stuff, and they've got a lot of capital, pretty quick to arb it away. That'll be, you got to be pretty quick, and it'll be there and gone before you know it. In crypto, same kind of similar trade, you might be sitting on it for multiple months before it kind of goes away, whether it's as a result of a large flow that takes a while to get digested, or whether it's just a function of thin markets in certain points of the curve, or not that once the kind of a lot of the similar types of accounts like that Vol RV types are in it, then if it's not back in line, then who is left to push it back in line? So I think the opportunity is there, but the path of your payout for that vol spread, let's say, or that RV opportunity to come back in line is very different to what you'd see in a traditional finance market. So I think it's more about the there are inefficiencies in both markets. Maybe they're larger in crypto, but then they also take a lot more of your VAR to actually capitalize on. That's certainly one difference.
That's interesting. So an example of the relative vol trade of FX versus crypto, in the FX world, you could see vol kind of self-correct, but in the crypto world, you basically put it on and basically have to hedge it all the way through and hope that the realized vol would kind of.
Or so I'm terrible with dates, but I think it was after the big crash last year, on the way back up, there was a lot of when it got kind of bullish again, there was a lot of like minor type of flow, pushing skew down quite a lot. So it was like a skew that was probably too negative, or I guess in crypto terms, too positive rather, too much for puts. So, there was a relative value opportunity in a certain part of the curve there where the skew was way out of whack relative to the other points of the curve. But that opportunity took quite a while to actually normalize because like the flows were ongoing basically, and they basically kept pushing it that way. So while there was like a RV opportunity there, it was like obvious but not easy to monetize per se.
Yeah, that makes sense. So in this particular case, you're saying that miners were buying a lot of puts, and therefore puts were becoming more bid than where they traditionally seem to be priced.
Yeah, or at a certain point of the curve was, of puts was a lot more aggressive than other points as well. So, there was money, but it wasn't like you just put it on and then everyone else agrees and then it goes back to neutral the next day, like you would get in a traditional finance market.
Yeah, very interesting. Great. Thanks, Josh. Brett, we'll jump over to you real quick. So just kind of piggybacking on this conversation, maybe there's a couple points to touch on. The first point is, where do you see the efficiency of the crypto market relative to traditional finance markets? And then we could sort of get more into the details of the vol of the crypto market versus traditional finance.
Yeah, I'd probably echo what Josh said. I mean, you'll see stuff moving ahead of events and things will be priced in. I don't know. I mean, I feel like there's some component where good or positive news will come out and it just takes like days or weeks to play out. So that's a bit of a weird one, right? I mean, I remember it was like the PayPal thing, and what was it, like October maybe? Like the market reacted positively, but there wasn't much reaction involved, and that kind of was just like, well, like, cat's out of the bag type of moment, where it really took a few weeks to play out. And I think there are a few of those, but by and large, yeah, I'd say it's efficient in some ways, but the monetization path can be absolutely brutal, right? I mean, like you're looking at, futures in particular too, right? Like a few months ago would have seemed like a layup to short basis, right? And then it rips to 50% in your face, and not many people can, how much capital do you have to finance that trade, right? So, yeah, so it's I think it's a lot of the inefficiencies come from capital constraints, specifically within the crypto space, and the inability for the people who are compressing those spreads in traditional markets to actually get on derivative screens or on Binance or whatever and push the market back to where it's quote unquote efficient, right?
Yeah, that makes a lot of sense. So you basically got to hold it and sort of realize the fundamental value to the expiration. So in the case of a basis, you basically got to hold it all the way through and capture the yield that you agreed to capture on the cash and carry trade from the get-go. That's very interesting. And then how do you view sort of the volatility curves in crypto? So something that we notice is that in traditional markets, if you look at stock volatility skews, for example, they're a lot more skewed to the put side, or a lot more bid to the put side than the call side. Whereas crypto is completely the inverse. It's sort of like it resembles more of a VIX skew or a Japanese yen skew, where it's basically people will bid a lot for the calls because they know that the volatility is going to come from the upside as opposed to the downside. I call it sort of the 2017 versus 2018 effect. And is there sort of another structural element to that, or is it just because this asset's new, it hasn't been around long enough, and anyone's game to call it?
Yeah, I mean, I think it has a lot to do with, I mean, I think Julien mentioned this, like there's not it's not a fun trade to be out there scooping up puts, right? I mean, you had a few months there where people were absolutely scarred, right, from what happened in March. But like by and large, the opportunities from the long side. And I think there's also a component where like everyone's, to some extent, like everyone's kind of long Bitcoin in the crypto space, right? So it's like, who's buying, the super teeny puts? Like it's not it's not a scenario that many people would like to imagine, right? Everyone's kind of one team, one dream here, it seems. Yeah, I mean, there's just not much systematic protection being sought, at least at this point. And I think that might change as more people come in and they're like, all right, look, like we have some core holdings, and then or as more kind of like, there's some like lenders coming into the space or protecting a certain LTV when as Bitcoin becomes more increasingly used as collateral, that sort of stuff. But yeah, I mean, like right now, it's been largely up and to the right. I mean, and you're seeing that sort of like reflected in, you have like all your sort of GameStop and all those sort of names, right? Completely flip the script on traditional equity market skew, right? And that's it's a lot of the same behavior, right? Just assets become absolutely explosive. So
yeah, that's a great point. Absolutely. Julien, do you want to comment sort of on some of these aspects, whether we're talking about skew or sort of the efficiency of the market?
Sure. I think I have something to add to what Brett said. Basically, I think the shape of the vol surface depends also like on the type of players that are in the market. I mean, with crypto, it's still, I mean, it sounds a bit strange, but still, despite already being started in 2014, basically, or like really early, it seems that there's not enough capital in the market to like flow into all the different holes and gaps that are there. And if you want to get into crypto, you have to learn about it, you have to read about it, then you open a wallet, and then you buy your first Bitcoin. So naturally, I would say most people who get into crypto want to be long or want to have some kind of long exposure. So I think that's what's giving also this market this big updrift in the past. And that's also why we see most of the time that people want to have some sort of long exposure. Like nobody wants to buy puts because he wants to make big bucks if we gap down, like for some whatever reason, because that's most of the case not why people are somehow in crypto. That doesn't say that these trades can have some great risk reward. So the vol shape, in my opinion, is a function of that. So most of the time we see this this heavy call skew, and it's always coming back, and it has always come back, and only after like a really big event like in March, it gets to the puts, like it gets used to the puts. But I think this is something which is certainly going to change in the future, because it cannot go on like that forever, I would say. Like I don't know, I've traded commodity options in the past, so there we see sometimes completely different shapes. I mean, for example, the oil volatilities like Brent vol or WTI vols, they are extreme heavily skewed to the puts basically every time. It's like kind of a structural thing, sort of kind of unthinkable of crypto right now, because it's like the completely opposite in the crypto world. But still, yeah, I just think that's something which is going to change. Yeah. And then I have something to add to what Josh said regarding the specific events. I think in crypto, there are very little events that are like, which can be some sort of priced in on the vol surface. Probably the only event I saw myself was the Trump election, where we could see that for some reason votes overall were lower, and only the ones during the election votes were like a couple of vote points higher up. But even that, I mean, if you put that into perspective, was very small, that bump. So most of the time, I would say the big vol shapes come from the big moves that we see, and the really, we know with crypto, it can do a lot of time nothing, and then it can do like it can just go flip from one phase to like from a phase of not moving into a phase of going nuts into like just one move basically, or during just one day. And that's probably what's most of the time determining the vol surfaces.
Yeah.
Like also and also like during the March crash, like there are a couple of vol events which are quite interesting. One was the March crash, obviously last year, where certainly every put seller got annihilated. Still, everybody's kind of survived, and I don't know, a lot of players went bust on that move, like no idea. There must have been some, but I don't know a lot of them. And the other thing is, for example, like how we see these different vol effects. I think a lot of it's also just driven from price action. I mean, right now, for example, we see that vols are being sold off, and we are near all-time highs, and vols have constantly coming off. You could say like, I knew that the market makers were asking like, why the fuck is this happening? Because like it seemed weird that vols are coming off so aggressively. But then, I mean, if you just think about it, like who are the players who are now trading options for the big part? Like, there might be some people who buy calls during the way up. Okay, these are I would say these are still not the majority. Then there are people who sell calls above the highs, just as a yield enhancement method. And then there are put sellers who sell puts below, I don't know, the Tesla spike, just to generate some yield. And in the end, you get overall net vol sellers, and that compresses vol as well than the market. So yeah, I don't know. That is my view on that one.
Love it. Thanks, Julien. Josh, we'll jump over to you. So we're starting to see some options on new altcoins. So we've seen Bitcoin Cash options recently released on bit.com. What's your opinion on sort of these altcoins? What's your opinion on Bitcoin Cash? Do you plan on trading Bitcoin Cash options? Do you trading options on different altcoins? Is that something that you see some demand for in the market, is to start listing options on altcoins?
Yeah. But I'll just quickly say one more point on the previous discussion, because I thought that was quite interesting. And I think Julian's point around like not that many events that have a big vol impact, I think that the effect you get is that you get gamma events, but not vol events, basically. So you get things where you really want to be in the front of the curve and it's a spot driven move and you can monetize that with your gamma, but doesn't necessarily equate to the vol market moving, especially once you get past the front end into the belly and the back end, where like it's hard to support really high vols forever just because of how much it needs to move over the years, over a year. And the other point I was going to make was that I think, generally speaking, the front is quite, there's quite a high correlation between, like quite a high spot skew correlation. So like the skew moves around with the spot. But once you get to the very back end of the curve, that's when you see the like more persistent bid for calls, right? Because people are permanently bullish on that asset class. So that was just on that. BCH, I have no strong view. Happy to trade it around if there's a good trade to be done. Alt options, yes. I'm bullish alt options as an asset class, generally speaking, as you would probably expect, because I would think there's a lot of opportunities there trading them by themselves and trading them versus other crypto option, like BTC and ETH. So I do think that's a growing, will grow, is a good area. Is tradable now, right? Like firms like Galaxy, I think, and Genesis and stuff will do altcoin options. I think that market generally can be a bit tricky because there's no easy way to lay off that risk if you're making size markets to someone who knows what they're doing. So I think they're not the easiest markets that are being made, but I think they'll get better over time as it becomes more possible for them to get better. In terms of like what alts should you have option markets on, it's unclear to me that the best alts to have option markets on are the alts that have been around the longest. I think, that probably makes sense. Well, the way I would personally approach it is think like, what are the 5 alts that I think are going to have the highest volatility, the most adoption, or the highest volumes over the next like 5 years? And whatever those 5 alts are that I think, they'd be the alts that I would make option markets on, or list option products or whatever. That's how I would approach it personally. But I mean, I think it's a no-brainer. And I think there's a lot of opportunity in some kind of, without getting too technical, but in like some correlation stuff, trading the implied cause between the coins, which, you would see, for example, if you had ETH BTC option markets. But we'll see when that stuff happens. Let's get ETH BTC derivatives markets, I guess, before we have options on ETH BTC.
Love it. Thanks, Josh. Brett, we'll jump over to you. Where do you see sort of the growth in sort of altcoin derivatives? Do you guys, is there a demand for some of the altcoin derivative flow? Have you guys started trading, Bitcoin Cash option markets, or is that still kind of a small market for you guys? And where do you see sort of that demand?
Yeah, so we've been active in the OTC alt markets. I'd say previously it was pretty much just limited to kind of your top 5, top 10. BCH is obviously a big one, and I think that's I think the fact that there's I wouldn't say super active, but I mean like it decent sized OTC market between a few of the players. And I think that's a large reason why it's now obviously listed on bit.com, right? But yeah, a handful of the others, some Litecoin, EOS we've done in the past, things like that, stuff that's been around for a while, to Josh's point. But I think, you know, going forward, where it makes most sense to me right now is kind of like the DeFi options, right? Or the DeFi names, because it's to me, it seems like you're gonna see a bit of a guard change between kind of what's in the top 10. You're already sort of seeing that, right, with like Uni creeping into the top 10, things like that. And you'll have kind of people who are fundamentally long a lot of this stuff, staking and governance. They want to get some sort of protection. So there are a lot of reasons why I think that market could grow, and the volatility on those names is, I mean, it's absolutely mind-bending, right? I mean, these things move 5-10% every hour on crazy days, right? Yeah, I think there's going to be demand for it, but the main thing holding it back right now is like they haven't been around for very long, right? I mean, Bitcoin's, you know, the Bitcoin vol market is liquid and you know, relatively efficient. But I mean, even ETH right now, I mean, like the markets are pretty wide compared to Bitcoin, right? And BCH even more so, right? So I think like the liquidity in you know the current listed options markets has to improve, and then the spot liquidity for names that, you know, could potentially be listed eventually. I mean, like you have like a lot of these DeFi names or you know, anything outside of like your top 4 or 5, you know, you might see, you know, days like, oh, like triple digit millions in volume, but I think everyone knows that that's pretty much all happening top of book. Like liquidity's not really there yet, right? So, you know, if someone's running a delta neutral strategy on sushi options, right, like you're gonna have a hard time punting off a bunch of that immediately. So yeah, I think it's a function of like these assets just need to just stick around for a little longer, see what shakes out. But I think there's definitely potential for growth in that space.
Cool. Thanks, Brett. Julien, we'll jump over to you. And if you want to just kind of piggyback off that last topic, feel free. And then we'll sort of jump into maybe your opinion on the DeFi space and DeFi options specifically, if you see sort of an opportunity growing there.
Yeah. I mean, regarding the altcoin options, I would really love to trade them too. Because we are only like, the thing is OTC, a lot of stuff is trading, but the thing is to trade OTC and set this up, it's a bit more complex to do. Like you need to have probably a company in place or so, or like have agreements in place and stuff. So that's usually like a big market entry barrier. So ideally, whatever is traded has to be traded on screen and have like, it always helps to have like at least some visible vol surfaces where you can orient yourself and stuff. So yeah, but I agree with the liquidity. Like Ether options are like relatively speaking wide, but I mean already much better compared to where they were like a year or 2 years ago. Whereas Bitcoin is kind of has tightened up, but it's kind of similar to where it has been already in the past. And Ether is now kind of slowly getting there. But yeah, the question is which altcoins to launch. Probably the ones that have the highest trading volumes, I would say, because I mean immediately like what we need is the biggest liquidity in order to hedge it and in order to be able to make markets on it. Because kind of if you have that risk in the book because you made some market or sold some puts or calls, like there needs to be a way to offset that risk somehow, and the costs for that need to be kind of manageable. So if it's something in super illiquid coin, like I don't know, recently I looked into Balancer, for example, like it's just so illiquid, like you cannot just market buy a couple of millions of it if you really need it because of some big delta or gamma effect. So that's like that's why I think like probably we need to altcoin markets with the highest liquidity. So but also like at the same time altcoins which have been sort of lindy because like which have been around a bit, because you never know how long these big high volumes are going to stay there. So it might be that it looks like, I don't know, right now Uniswap is pretty high, like it's pretty hot. I could say, okay, then let's launch some Uni coins. Seems like that it was the first big DeFi exchange. It's probably going to stick around for a longer time. So I would say probably that is something which could be Lindy, but at the same time, like, could be that it gets overtaken by a sushi swap at some point, and then nobody's interested in Uni anymore. So it's really difficult, because also from a market maker's perspective, once you launch such a product, it's not like a natural thing that immediately the screen is full and prices are there. Like, I don't know, sometimes we forget to quote on Ether and we get approached by the exchange to please make markets on Ether again, because the screen is empty. And I would think sometimes like, okay, well, we are definitely not the biggest market maker. For sure not. When we offer, nobody's quoting, like so it needs to be really liquid coin. But so it's maybe one strategy would be to start just with a 1 month tenor and see if it attracts liquidity or not, and then just ditch it if it doesn't work and get something else. But I'm not sure like what's the best approach there.
Yeah, that's very interesting. So we got about 20 minutes left. I think maybe we'll just kind of close up with a last 2-minute kind of answer from all you guys, and then we'll open it up to some questions from the audience. So just kind of real quick on a closing note, do you see any opportunity in the DeFi options? Is that something that you think has any legs to stand on, or is this kind of too capital inefficient and too far off?
And maybe I should bounce the ball better to Josh, because I think he has already done some stuff on the DeFi options. For me, I mean, I have looked into it, but it seems just so inferior to CeFi at the moment. It's hard to find a case there. But I mean, I don't know. Let's play the ball to Josh.
Sure. Yeah, I mean, what's my view? My view in a nutshell is yes. Sorry for coming super close to the screen then. My view in a nutshell is yes, there'll be a thing. Do I think AMM option, like option AMMs on options will be a thing? Remains to be seen. I'm not sure you want to be like negative gamma squared per se. Having said that, if you get layer 2 going, like reduced gas fees, scaling, all that jazz, there's no reason in my mind why you can't have a similar experience trading DeFi options to a CeFi product. And there are lots of people who don't want to go to CeFi places but would prefer to go to DeFi, even if it is a bit suboptimal. I've spoken about some of the issues before on things like Uncommon Core, predominantly around margining for short options. I mean, there's like just simply no chance that I'm ever going to trade a short option where I have to deposit full collateral. It's just not going to happen. But you need some liquid hedging mechanism. Like Derivatives got a very good mechanism there with their portfolio margin. And so, that's a big thing that needs to be solved, I think, for it to really get traction or really, really grow. But I think even if it does, I think there's a pretty good chance it works. Even if it doesn't work, there's a lot of people who are going to give it a crack, and at least a few of them will get partway there. So, it kind of remains a bit to be seen. But, I mean, where we do trade DeFi options, we have invested in a DeFi options play that we're pretty excited about. So, and we're working with a couple of others to help them out on some of their products and stuff, like helping with liquidity on the actual option side. So there's people giving it a shot. I think they've got a reasonable chance, subject to external things being solved.
Cool. Love it. Thanks, Josh. Brett, if you just want to kind of closing remarks on sort of this topic or anything else, and then we'll open it up to questions.
Yeah, I mean, we're not, we haven't looked, I mean, we can't necessarily touch a lot of the DeFi stuff directly as a publicly traded company, but yeah, I mean, it's fascinating. I think, I mean, it's the same issue that every other application Ethereum is running into, is scalability. You don't want to be like to Josh's point, like an AMM on options just doesn't seem really feasible or desirable right now. So yeah, it had to be on some sort of layer 2 thing. There's a bunch of layer 2 stuff coming out. So yeah, I mean, like we'll see how it goes, but we'll be watching it closely. But yeah, it still seems like it's a bit early days.
I should probably clarify that I do think there are interesting ways that you could seek to mitigate some of the problems with having AMMs on options, but we'll see how they kind of, come to light and how they work. But like, I think the market's generally aware of that as an issue and kind of looking to solve it in whatever, way the relevant individual can come up with.
Cool. Love it. All right. So we're happy to sort of take some questions from the audience. If anyone has some questions, feel free to chat it in the chat box, and I'll go ahead and ask it to our panelists. And let us know if the question is directed to any individual one of our panelists. So we'll just give it a moment. All right. So this is from Anon. So what market infrastructure developments and options are you most excited about? Paradigm launched their API, which has been a game changer. Any thoughts on that?
Do you want to take that one, Julien?
Yeah, you fire straight up the ad. Yeah, I mean, I must say, but like for me, obviously, APIs towards anything are always like super awesome because it just makes life so much easier, and it allows more innovation basically. Because seamless APIs is what's at least was hindering myself from entering kind of automated into the legacy trading world, like options on equities or options on commodities. Like it's like a super manual process, and having API connectivity very easy towards whatever out there is in my opinion absolute key. In particular because maybe because collateral management in the crypto world, because it's decentralized, is also kind of really difficult because you have so many different areas where you can put your money in, which are obviously decentralized, and so many different pools which then are not connected to each other. Like the DeFi options is a good example. The problem is like you could trade DeFi options, but then you would need to hedge your delta. But if you hedge your delta on a different exchange, suddenly these risks are not offsettable kind of. So probably the biggest infrastructure development I would like to see is like more like kind of, I don't know, centralizing the collateral probably, but then we get back to centralized exchanges. So yeah, I don't know, like probably something around collateral optimization.
Love it. Love it. Anyone else got anything to add?
I mean, in options specifically, I think clearly Paradigm are the leader in the block stuff and doing a lot. So props to them for that. And I think I have to admit, I haven't done a deep dive into the API yet, though I will. But I'm sure it'll be good. And then there obviously some other solutions coming up around market analytics, right? For those who don't have everything inbuilt in-house, like Genesis Vol, etc. So I think, they're super useful for from the trading analytical side. There's others as well, of course.
Awesome. Appreciate that. Just kind of we also have just kind of a reminder to everyone, we also have a trading competition going on over at bit.com. And so that's going to start at the end of March. So if anyone is interested, there's a bunch of prizes. There's about $1 million in USDT in prizes. And there's a trading competition for both sort of API systematic traders and also on-screen click traders. So that's going to be open until the end of March. We have another question here from Roman. Okay, so the question tangent to the altcoins options. In my opinion, first step will be the launch of BTC margin futures. Regarding that, what main obstacle do you see? Will this product offering happen first on DeFi or CeFi? So I think maybe what he means is maybe DeFi.
Well, they're like, we have BTC. Sorry, the question just got flicked down my screen. We have BTC margin futures. Deribit has them. Mex, Bytebit, Binance. Most exchanges have them now. So I don't think that's that's an obstacle per se. Certainly not in CeFi. DeFi, you have the same issue around scaling experiences, but there are quite a few DEX protocols popping up now that are pretty good. You know, worth giving a crack with some small amount of capital per protocol. You know, Derivatives, there's heaps of them. I'll forget them, but yeah, I think that they're around, generally speaking, if you snoop around.
We have a question from Gerard here. What's your views on demand for 3-year plus options?
I think it's a pretty interesting question, because we, like Orca traders, is actually focused more on the longer dated maturities on the option side. I think our market share on the far dated options is actually pretty considerable. And to be honest, like, I think it depends on what kind of I think the more players look at them, the more liquid they get on Deribit, the more liquid they will also get. The further out we will be able to roll out the maturities. I mean, right now, it's always a question about liquidity. If you look at the front options, they're super liquid because the spreads are super tight, because kind of the risk factors are all kind of smaller. On the far dated options, you start to get really big Vega risks, even on already small positions. And that's kind of usually very difficult to offset. So I just think as more as the capital base of the players grows and the experience in the market grows, the further dated out we will be able to launch, we will be able to see like options launched further out. But that's also kind of maybe an interesting strategy for DeFi options or for bit.com, because kind of the difficulty is always if all exchanges offer the same stuff. And it's always interesting if it always lures more people towards something if it offers just something different, which would be then the reason why I would go there. Like, for example, on DeFi space, if I could buy calls on SushiSwap, maybe I would actually start more looking into that, because else I would go to the exchange which has the highest capital efficiency, which is currently either bit.com or Deribit. So yeah. That's my take on that one.
Cool. Brett, maybe I'll ask that same question to you. Do you see are you guys making markets OTC for long dated options like that? Do you see any demand for it? Is that something you guys would do? Is it just too far out on the curve to take that risk?
Yeah, we've had some people. Seems like more fishing for information at this point than anything actual. I think the furthest out that we've done maybe like a year and a half. It's I think largely a function of A, obviously crypto's only been around for 10 years, and B, you haven't had that many sophisticated market participants who are like, hey, I'm buying X amount and I'm going to hold this. This is just part of my treasury, right? You're starting to see that now. So I think as Bitcoin and crypto more generally becomes normalized as an asset class, that'll naturally happen. But yeah, it's kind of like if you build it, they will come type of thing. We'll see. There's not, even the December stuff right now is not crazy liquid. I know Orca is super active in it, but yeah, past the year we haven't seen a ton so far.
Cool. This question is from Elliot, and maybe this is for you, Josh. So do you, as a market maker on Paradigm, do you see any typical structures that people like to put on a lot? And what do you think is the driver of that structure? Is it mostly just kind of a liquidity type of thing?
I think I will handball this one to Julien. I think he will be able to answer it probably better than me.
Yeah, I would say the most famous structures are call spreads, definitely call spreads, because people see vols above 100%. Immediately, the first thought is vol is probably too expensive. It actually doesn't matter what the underlying does, but if people see vols in triple digits, that's the first thought which comes with it. And then call spreads is a very simple play to just get long exposure with little risk and get this, at least on paper, in theory, a pretty good risk reward. So I would say, yeah, the most common product is, the most common structure are call spreads. Sometimes we see also butterfly spreads and put spreads. I don't know. Yeah, I would say the structures which are asked for have increased massively. It's just the growth which we've seen, especially since Paradigm launched, is incredible, because now these structures are able to be traded, and the markets on these structures can be sometimes really tight, because pretty often you get actually players which answer these requests which have access. So you sometimes even can buy or sell these at mid prices. So yeah, I would say the most common structure is definitely the call spread.
Yeah,
I will admit I do like buying puts. I love
Well,
buying puts personally, but maybe I'm
Don't
the
like
only
it.
one. And I'm bullish, don't get me wrong, but I still like buying puts.
yeah, no, actually I agree because I'm also kind of a put buyer. So
Yeah,
it
I
seems
think
like
it's
people
pretty
often make mistakes.
asymmetric. The worst case, you can be longer if you want to be.
Yeah, yeah.
totally. All right, we'll take this last question and then we'll probably call it a wrap. So this is from Nick G. He says, how do you see the market for structured products with payoffs linked to crypto development? Can you see something like this in DeFi? So
Ribbon Finance is doing some covered call DeFi option stuff. So you can check out their Twitter. I'll have to look up what it is exactly. I'll post it on the chat. So there are people looking at. Sorry, I'm on my computer now. There are people looking into doing structured products in DeFi. I actually think it's kind of right for it in the sense that you have all the vaults, which are almost like a form of a structured product, like a structured fund. So here it is. I do think there is that stuff happening. 1 second. How do I get this? That one. So Ribbon Finance are doing stuff in structured products. In terms of the actual structuring of said product, there are Chinese firms out there who are selling structured products now, I believe, in quite a big size. Or they have been. I'm not sure if they're doing it at this very moment, but they've definitely been offloading structured products into the market.
All right. And then actually got one more. This is from Damien. Are exchange fees a burden to tight spreads?
Definitely. I mean, they're definitely a part of it. I mean, especially on the structures. That's kind of something which is really a pain in the ass right now because the fees we pay on a daily basis on especially big structures can be really mind-blowing, also in relation to sometimes the risk that they have. Because especially if you have multi-leg structures, currently how fees are working on the crypto space is you have to still pay fees for each individual leg. And usually we would say, okay, if I buy a call spread, actually I have less risk factors, so it should be actually cheaper to put it on, but or butterfly spread. But then on the other hand, like due to the fee structure currently, is actually more expensive. So that's certainly like a big burden. Like, yeah.
Yeah, that's very interesting. All right. So, actually, Bit.com says they have a discount on multi-leg options, 50% off on the lower leg. So that's pretty interesting. Well, that's cool. Maybe Cynthia, if you want to jump in and just let everyone know where they can find the recording, and then maybe just let them know where they can sign up once again for the trading competition that Bit.com is hosting, and then we'll take it from there.
Sure. Thanks everyone for the wonderful panel. We already recorded today's session, so we're going to share the upload it onto YouTube. And tomorrow I'm going to send a group email to everyone who has signed up, and so you have the record and also you have all the links that you know. And just to mention that we're going to run this webinar on monthly basis. So it's hosted by Genesis Volatility, Paradigm, and Bit.com. So every time we will invest different guests to bring different color of the market. Yeah, so stay tuned. We're going to keep you posted for the ongoing sessions as well.
Cool.
Sorry about that. Perfect. Thank you. And do you mind just dropping a link for the training competition maybe in the chat room so people can know where to go to sign up for that?
Sure.
And then, well, I want to thank all our panelists. Thank you so much for taking the time to sort of, give us your perspectives on the market and take the time out of the day to come on this panel. We really appreciate it. So thanks, everyone.
Pleasure. Thank you.
Thanks, guys.
Thanks very much. Thanks for your time.
All righty. I'm off to bed. I'll see you guys.
See you later.
Alrighty.
See
Ciao.
you.
Bye. See you.
Bye.